Hello everyone, and welcome to the channel. In the rapidly expanding digital universe, data is the new oil, and data centers are the critical refineries. At the heart of this global infrastructure is Singapore, a Tier 1 hub that connects continents and powers the digital economy. The year is 2025, and the demand for data has never been higher, supercharged by the explosion of generative AI, cloud computing, and the Internet of Things. In this high-stakes environment, strategic moves by key players can reshape the landscape. Today, we are taking a deep dive into one such move, Keppel DC REIT's consolidation of two state-of-the-art AI-ready data centers in Singapore. This isn't just a simple real estate transaction. It's a calculated play that deepens the REIT's strategic position in one of the world's most important digital markets. We'll explore the deal, its financial impact, the powerful growth drivers, and the significant risks involved. Let's get started. First, a quick disclaimer. This video is for educational purposes only. It is not financial advice, and it should not be taken as a recommendation to buy or sell any security. Please conduct your own research or consult with a licensed financial advisor before making investment decisions. So let's get into the details of the transaction. What exactly did Keppel DC REIT do? The company acquired the remaining 51% stake it did not already own in two key assets, Keppel DC Singapore 7 and Keppel DC Singapore 8. This move gives them full 100% ownership and control. This was made possible through a call option, essentially a pre-agreed right to purchase the stake from its parent company and sponsor, Keppel Limited. This highlights the powerful synergy between the REIT and its sponsor, creating a pipeline for future growth. While the final purchase price for the stake is subject to adjustments, the underlying value of these two facilities is over 1 billion Singapore dollars, underscoring their importance in the REIT's portfolio. The acquisition was funded prudently, using a combination of existing debt facilities and the REIT's own cash reserves. Now, why does a deal like this even matter? Taking full ownership is a game changer for several reasons. First, it grants Keppel DC REIT complete operational control. This means faster decision-making on everything from leasing strategies to asset enhancements, without needing to consult a partner. In the fast-moving tech world, this agility is a significant competitive advantage. Second, it directly enhances income stability. With 100% of the rental income flowing directly to the REIT, distributable income gets a direct boost. These facilities are designed for hyperscale tenants, the giants of cloud computing and AI, who typically sign long-term leases, providing a predictable and secure revenue stream for years to come. Most importantly, this move firmly positions the REIT to capture the explosive growth from AI. AI workloads require immense computational power and high-density environments, something that SGP 7 and SGP 8 are specifically built for. By owning these assets outright, Keppel DC REIT is not just a landlord, it's a critical enabler of the AI revolution in Southeast Asia. This directly aligns with the broader New Keppel vision of its parent company, which is shifting towards an asset-light model focused on managing high-value, income-generating funds. So what does this all mean for the bottom line? The positive effects of this strategy are already visible in the REIT's first half 2025 results. Gross revenue surged by 34.4% year-over-year to 211.3 million Singapore dollars. Net property income, a key measure of a property's profitability, grew even faster at 37.8%, reaching $182.8 million. For investors, the crucial metric is distribution per unit, or DPU. This grew by a very healthy 12.8%. Now, let's look at valuation. Keppel DC REIT trades at a trailing price-to-earnings, or PE ratio, of about 14.1 times. This is notably lower than its peers, Mapletree Industrial Trust and CapitaLand Ascendas REIT, which trade at PE ratios in the range of 16 to 18 times. This suggests the market may not have fully priced in Keppel's recent earnings growth. Interestingly, the story flips when we look at price to net asset value, or P to NAV. Keppel DC REIT trades at a premium of 1.5 times its book value, while its peers are closer to 1.2 times. This tells us that the market places a very high value on its specialized data center assets. This discrepancy, a lower PE but a higher P to NAV, is a key dynamic. suggesting investors recognize the quality of the assets, but may be underestimating the REIT's earnings power. The balance sheet remains strong. Aggregate leverage stands at a manageable 30%, well below regulatory limits, providing ample debt headroom for future acquisitions. The interest coverage ratio is a robust 6.9 times, meaning its earnings can comfortably cover its interest payments. Looking ahead, what will drive future growth? The outlook for data centers in Singapore looks incredibly bright. The primary growth driver is the relentless expansion of hyperscale cloud providers like Amazon, Google, and Microsoft. As more businesses move to the cloud and AI adoption accelerates, the need for data processing and storage capacity will only grow. Furthermore, after a multi-year moratorium, the Singaporean government is now selectively allocating new capacity for data center development, prioritizing operators who can meet stringent sustainability standards. This creates a high barrier to entry and benefits established, green-focused players like Keppel DC REIT. Singapore's strategic position as a global connectivity hub with numerous subsea cables landing on its shores further cements its importance. Of course, the road ahead is not without potential obstacles. The single biggest challenge is energy. Data centers are immensely power-hungry, and volatile electricity costs can directly impact profitability. Managing these costs through efficient design and long-term power purchase agreements is critical. Regulatory risk is another factor. The government's focus on sustainability means strict rules on energy efficiency, and failure to comply could hinder growth. Competition is also intensifying. While Singapore is the premium hub, neighboring markets like Johor in Malaysia and Batam in Indonesia are emerging as lower-cost alternatives, potentially drawing away some investment. Finally, like all REITs, Keppel DC REIT is sensitive to interest rates. Higher rates increase borrowing costs, which can put pressure on acquisitions and DPU growth. In today's investment climate, sustainability is more important than ever. Keppel DC REIT has a strong profile here, earning a verified low-risk ESG rating of 12.5 from Sustainalytics. This isn't just a label, it's backed by concrete action. The newly acquired Keppel DC Singapore 8 has achieved the prestigious Green Mark Platinum Award, the highest sustainability certification from Singapore's Building and Construction Authority. This facility incorporates advanced, energy-efficient cooling systems and water conservation technologies. This commitment to sustainability not only mitigates environmental risk, but also appeals to the growing number of institutional investors with green mandates, potentially lowering the REIT's cost of capital over the long term. So, to bring it all together, Keppel DC REIT's move to consolidate its Singapore data centers is a powerful and strategic decision. It strengthens its financial performance, enhances its operational control, and positions it perfectly to ride the massive wave of AI and cloud adoption. The REIT is supported by strong industry tailwinds, a clear growth pipeline from its sponsor, and a robust balance sheet. The valuation presents an interesting narrative, where the market loves the assets but may still be catching up to the earnings story. However, investors must remain mindful of the risks, particularly rising energy costs, regulatory hurdles, and regional competition. The road ahead requires disciplined execution and a continued focus on operational excellence and sustainability. What we have discussed today is an educational overview of a significant corporate development, not investment advice. The future will depend on management's ability to navigate these opportunities and challenges effectively. Thank you for joining us for this in-depth analysis. If you found this video informative, please like, share, and subscribe for more content on the companies and trends shaping our global economy.